If you've traveled overseas, you've likely had to exchange currency. And if you came home with extra foreign cash, you might find that the exchange rate changed, leaving you with more or less money than before. Exchange rate fluctuations can also affect the return on your investments. Hi, my name is Caroline Maughan, and I'm an Associate Portfolio Manager at Claret Asset Management. Today, I'm going to explain how currency risk can affect your profits and when you should hedge your currency exposure when investing in exchange-traded funds, or ETFs. When investors think about risk, what comes to mind first is losing value. In other words, when the price of an investment falls below what they initially paid. Price risk affects all types of investments, regardless of whether they are foreign or domestic. A proven way to decrease your risk is by diversifying your portfolio and investing in different asset classes, industries, sectors, markets, or countries. But when you diversify your portfolio in different countries, with investments that trade in foreign currencies, you're faced with another type of risk, known as currency risk. So what exactly is currency risk? Currency risk is specific to investments in foreign markets denominated in a foreign currency. It refers to the risk that the value of an investment will decrease due to changes in the exchange rate between your domestic and the foreign currency. Just like when you travel, if you invest in a foreign stock, you first have to consider the exchange rate at the time you're making the investment. Let's look at an example from the perspective of a Canadian investor buying a stock trading in US dollars. Let's say the exchange rate is 1.34 between the Canadian and the US dollar, and you invest 100 Canadian dollars in a US stock. At this exchange rate, 100 Canadian dollars allows you to buy 75 US dollars worth of the stock. 1 month later, you're ready to sell the stock, and the price of the stock hasn't changed, but the US dollar is now 10% stronger than the Canadian dollar. Your US dollar investment is now worth 110 Canadian dollars. On the other hand, if the US dollar weakened by 10%, your investment will now only be worth 90 Canadian dollars. The effect on your profits is purely a result of currency fluctuations. Sometimes, exchange rate fluctuations can work out in your favor and increase your returns. But predicting when a particular currency may rise or fall is a challenging task. To limit currency risk, investors will use what is known as hedging. Currency hedging is a risk management tool that uses financial instruments such as forward contracts, options, or currency swaps to offset the effects of currency fluctuations on your investments. Currency hedging is a pretty complex strategy to engage in on your own. This is why currency-hedged ETFs can be a good investment option if you're looking to limit currency risk. A currency-hedged ETF is an investment fund that aims to minimize the impact of foreign exchange rate fluctuations on its returns. So which one is right for you as a Canadian investor? It really depends on 4 things: your investment outlook, your time horizon, the currency pair, and the cost of hedging. The first thing you'll want to consider when choosing a hedge or unhedged ETF is your investment outlook. While hedging may reduce the risk of unfavorable currency fluctuations, it also reduces the potential reward on favorable ones. We saw that the value of your $100 investment in a US stock increased by $10 when the US dollar appreciated and decreased by $10 when the US dollar depreciated. When investing in an unhedged ETF, you're exposed to the uncertainty of making or losing $10 due to currency fluctuations. When investing in a hedged ETF, the impact of currency fluctuations may be eliminated or limited, and your investment would be worth $100 regardless of currency fluctuations. This means you're protected against unfavorable exchange rate movements, but you also miss out on any potential gains. Now, if you don't have a specific outlook on exchange rate movements and you want an exposure to the underlying securities without the effect of currency fluctuations, then a hedged ETF may be more suitable for you. The second thing you'll want to consider is your time horizon. Currency can add additional uncertainty to the total return of a foreign investment, especially over shorter periods of time. An investor with a shorter time horizon might favor a hedged ETF to help reduce the impact that currency volatility can have on their portfolio. Currencies tend to revert to their mean and are less volatile over long periods of time, which reduces the value of hedging. The third thing you'll want to consider is the relationship between your domestic currency and your foreign currency investment, which is known as a currency pair. Unlike the Canadian dollar, the US dollar tends to be negatively correlated with equity markets, especially during periods of market stress. This means that it tends to rise as the world stock markets fall and vice versa. This can be a good source of diversification as the currency gains of the US dollar help minimize the losses in a falling stock market. Hedging your exposure to the US dollar would essentially remove the diversification benefits. Other currencies, like the euro, tend to be positively correlated to equity markets and add volatility to your portfolio that would be reduced with hedging. Finally, it's also important to consider the cost of hedged versus unhedged ETFs. Currency-Hedged ETFs typically have higher management fees due to the added complexity of financial instruments used to hedge the currency risk. Hedging is an additional trading expense which will eat into the returns you receive. Since there are different factors to consider when evaluating the level of currency exposure you want to have in your portfolio, it's important for investors to understand the currency risk associated with foreign investments in order to be able to make an informed decision that aligns with their financial objectives and individual situation. For more investment tips, visit our website at claret.ca or get in touch with us directly by clicking on the links in the description. And don't forget to click the subscribe button below.